The group designs and manufactures test probes and test sockets for the semiconductor sector. It is the world's top 3 leader in the high-performance test socket industry. Malaysia accounted for about 27% of the 2024 revenue. The bulk of the revenue growth over the past decade came from China. Over the past 12 years, the group achieved a 16% compounded annual growth in revenue. The majority of the growth came post-2020. However, revenue growth leveled off in 2023 with a decline in 2024. More troubling was the large drop in profits from 2022 to 2024. Returns show a similar pattern with an uptrend from 2013 to 2021. Thereafter, there were declining trends. Nevertheless, the average returns were such that shareholders' value was created. The drastic drop in performance was because fixed costs were about 3/4 of the total costs. With such a cost structure, a decline in revenue would significantly impact the profit margin. The group was also not able to reduce the selling, general, and administration costs post-2021. The group has been building up its cash. In computing the return on invested capital, I excluded cash, and this caused the return on equity to be about half of the return on invested capital. Given the cost structure, efficiency improvement would be an important factor in driving profit. But the group experienced declining capital efficiency as measured by the gross profitability. There were also declining trends in many of the operating and capital efficiency metrics. Compared to global players in the sector, the group is a very small player, but it had the best revenue growth. It displayed periods of outperformance in return on capital, EBIT margin, and EPS. However, its performance has been highly volatile and inconsistent. This suggests that while it demonstrated strong short-term growth, it struggled to sustain performance over time. I would rate the group as sound financially. This is because of its strong cash position, low debt-equity ratio, and good capital allocation. My main concern was the high reinvestment rate. Its intrinsic value was doubled book value, but it much lower than the market price. There is no margin of safety. The group faces several challenges from declining returns and high reinvestment rates. This more than offset its financial strength. At the same time, there is no margin of safety. As such, I would sit this one out. The information presented is for educational purposes only. For more details, read the blog article. Thank you.